Welcome to Alpha Insights. I'm Brittany. We are off the trading floor today. Markets are closed for Martin Luther King Jr. Day. So it's a great moment to step back and think about your big picture allocation. Joining me is Ryan, an investment advisor who helps people figure out where stocks and bonds fit in their plans. Ryan, thanks for being here.
Thanks for having me, Brittany. Always a good time to talk about the basics, especially on a holiday when you have a little breathing room to plan.
Let's start simple. What's the easiest way to explain the difference between a stock and a bond to someone who's new?
Sure, think of a stock as a tiny piece of ownership in a company. When you buy a share of Apple or Google, you own a sliver of that business. You make money when the company grows and investors pay more for those future profits, or when the company pays dividends. A bond is different. It's a loan. You lend money to a government, city, or company, and they promise to pay interest and return your principal at a set date. So stocks are ownership and growth, bonds are lending and income.
People always talk about risk and return. How do stocks and bonds compare there?
At a high level, stocks tend to offer higher long-term returns, but with more short-term ups and downs. Historically, broad U.S. stocks have returned about 9 to 11% per year over long stretches, but that number swings a lot year to year. Bonds usually return less. Think roughly 4 to 6% historically for government and investment-grade corporate bonds. But they generally provide steadier income and lower volatility. That's why stocks are for growth and bonds are for stability.
Can you give a practical example so listeners can picture how allocation matters?
Absolutely. Picture a young investor with a 30-year horizon and $10,000 to invest. If they go with an aggressive mix, 80% stocks and 20% bonds, and assume stocks return 8% a year and bonds return 3% a year, the stocks portion, $8,000, growing at 8% for 30 years, ends up at about $80,500. The bonds portion, $2,000 at 3% for 30 years, becomes about $4,850. Together, that's roughly $85,350. Big difference compared with a conservative split, because more money was in higher return stocks over a long time.
And for someone closer to retirement?
Say someone has $100,000 and a 5-year horizon and chooses 40% stocks, 60% bonds. With the same assumed returns, $40,000 in stocks at 8% for 5 years becomes about $58,800. $60,000 in bonds at 3% for 5 years becomes about $69,540. Total around $128,340. The higher bond share reduces the chance you have to sell stocks after a big drop.
So, time horizon is huge. What are the other practical rules people should keep in mind?
3 things stand out. First, match your time horizon and goals. Money you need soon should be in bonds or cash. Money decades away can handle more stocks. Second, diversify. Hold many stocks and bonds or broad index funds so you aren't exposed to one company or one bond issuer. Third, have a plan and rebalance. If you start at 60% stocks and a market rally pushes that to 70%, rebalance back so you don't unintentionally take on more risk than you wanted. Rebalancing once or twice a year, or when your allocation drifts by about 5 percentage points, is a common approach.
People also worry about inflation and taxes. How do those affect the stocks versus bonds choice?
Inflation matters because bonds can lose purchasing power if yields are low and inflation is high. That's why a pure bond portfolio can underperform in real terms. Stocks tend to outpace inflation over long periods, though with more volatility. On taxes, interest from many bonds is taxed as ordinary income, while qualified dividends and long-term capital gains from stocks often get lower tax rates. That means tax-advantaged accounts like IRAs or 401ks can be especially useful for taxable bonds.
What are the common mistakes you see new investors make?
Chasing recent winners, like buying a hot stock after a huge run, is risky. Valuation and risk still matter. Ignoring time horizon, putting money needed in the next few years into mostly stocks, exposes you to bad timing risk. Failing to diversify is another big one. Owning a handful of individual names concentrates company-specific risk. And finally, Not rebalancing lets your allocation drift and may leave you with more risk than you expected.
If somebody is listening right now and wants to act, what's a short checklist they can follow after we finish this episode?
Good question. Quick checklist. 1. Define your goal and time horizon. When will you need the money? 2. Honestly assess how you'd feel about a big drop. Can you sleep through a 30% slide? 3. Choose broad, low-cost funds for stocks and bonds. Think total stock market funds and a total bond market fund or a target date fund if you want a one-stop solution. 4. Set a rebalancing rule, like once a year or a 5 percentage point drift. 5. Review taxes and place interest-heavy bond holdings in tax-advantaged accounts if possible.
Great. Very actionable. Before we go, one last question. With markets closed for the holiday, any final advice for listeners to use this downtime productively?
Use the quiet to check that your allocation lines up with your goals, make any small adjustments, and set calendar reminders for rebalancing. If you're not sure of your risk tolerance, there are simple questionnaires, or you can talk to a financial advisor. Small, consistent steps matter more than trying to perfectly time the market.
Ryan, thanks for breaking that down in a clear way. For listeners, quick recap. Here are 3 takeaways to remember.
Happy to help, Brittany. Let's hear those takeaways.
1. Stocks generally offer higher long-term growth but more volatility. Bonds offer income and stability. 2. Let your time horizon and comfort with risk drive your mix and diversify using broad funds. 3. Rebalance periodically and use tax-advantaged accounts for interest-heavy bond holdings. That's it from Alpha Insights. Have a thoughtful holiday, and we'll be back when markets reopen.